Welcome to the debate. Today, we're tackling a high-stakes and, I think, highly contentious proposal that's circulating in Washington. It's one that seeks to fundamentally alter the architecture of American home financing. The 50-year mortgage option. Now, this is not just a tweak to interest rates. This proposal directly challenges the bedrock 30-year term established by FDR's New Deal to stabilize the market.
And the impetus is pretty clear. The current affordability crisis is, well, it's catastrophic. In a lot of critical markets, securing a median-priced home requires an income level that's often 2, sometimes even 3 times what the average family actually earns.
Exactly. So the central question before us is this. Does introducing a 50-year mortgage genuinely solve the affordability crisis by expanding access to homeownership, through drastically reduced monthly payments? Or does it merely function as a financially detrimental debt instrument that just exacerbates existing market instability and, frankly, traps a generation in debt?
I contend that this extension is a crucial, immediate tool. It provides the necessary leverage for millions of priced-out buyers to finally gain market entry. That calculation is certainly alarming, but I fundamentally believe that you are sacrificing the financial stability of the future homeowner for the immediate benefit of market access. While the housing crisis demands immediate and innovative action, I maintain that the 50-year mortgage is a deeply cynical proposal. It offers marginal short-term payment relief that is, in my view, catastrophically outweighed by the resulting massive half-century of long-term interest accrual. This proposal risks transforming homeownership from the principal engine of middle-class wealth into a multi-generational financial burden.
Okay. Let's ground this in the immediate obstacle faced by millions of potential buyers, which is qualification. The iron gatekeeper of mortgage approval is the debt-to-income ratio, or DTI. Now, this ratio, which measures a borrower's required monthly housing payment against their gross monthly income, is what determines eligibility under most federally backed guidelines. By extending the amortization period from 30 years to 50 years, you immediately and dramatically reduce the required monthly payment. This reduction, even if it seems small on paper, can drop the DTI ratio just enough to move millions of otherwise creditworthy families from ineligible to approved almost overnight. This isn't theoretical. This is about providing necessary liquidity and qualification power to people struggling with high cash flow demands.
And, historically, policymakers understood that longer loan durations were essential tools to restore affordability and liquidity in times of crisis. This proposal really just follows that tradition. Furthermore, securing a fixed mortgage payment, even one over 50 years, allows a borrower to hedge against perpetually rising rental costs. Over 5 decades, that fixed obligation acts as a vital economic shield against inflation, while renters face uncapped increases every single year. We also have to acknowledge the behavioral reality here. The total interest paid over 5 decades is a theoretical maximum. Most homeowners sell or refinance or pay off their loans long before the 30-year mark, let alone the 50-year mark. The primary value is getting into the market and securing equity growth now.
I'm just not convinced that $135 in savings is worth $500,000 in potential debt. You frame the 50-year amortization as this crucial hedge, but that hedge is very thin, and the risk of catastrophic interest accrual becomes a highly probable problem because of how slowly the principal is repaid. Let's actually look at the financial arithmetic. So assume a $500,000 home purchase with 20% down. If a 30-year fixed rate is, say, 6.2%, the monthly payment is around $2,450. To account for the increased duration risk, let's assume the 50-year rate is slightly higher, maybe 6.7%. The payment drops to about $2,315. That is, yes, a savings of $135 per month. But let's really interpret that trade-off. Over 30 years, the borrower pays approximately $482,000 in total interest. Stretch that loan to 50 years, and the total interest paid approaches a staggering $990,000. We are asking the next generation of homeowners to incur nearly $500,000 in additional non-productive debt just to save $135 a month.
This trade-off is, well, it's a bit like accepting an 8% APR on a credit card balance transfer just to lower the minimum monthly payment. It's prioritizing immediate cash flow over a crippling lifetime cost.
But you're fixated on that $990,000 figure. That assumes the borrower is both financially stagnant and residing in the home for the full 5 decades, which, as I noted, is statistically pretty improbable. The actual debate should be framed around the opportunity cost of waiting. If a buyer waits 5 or 10 years for rates or housing prices to magically stabilize, they might save that marginal $135 a month on a shorter loan. But what have they lost in that time? If home prices appreciate at a conservative average of 4% annually, which is a standard measure in recent decades, that waiting period means the purchase price has climbed significantly, potentially outpacing any future payment savings. The 50-year option allows buyers to secure that leverage and capture appreciation immediately. I mean, time in the market always beats timing the market, and the longer loan facilitates that crucial early entry.
The timing argument is compelling, I'll grant you, but I just don't buy that the price inflation risk is secondary to the qualification benefit. You introduce a massive demand subsidy, suddenly making millions of dollars of new purchasing power available without adding a single home to the inventory shortage, which analysts estimate at 3 to 4 million units. The immediate effect of this enhanced DTI power is that buyers can suddenly qualify for and are frankly incentivized to bid on more expensive properties. Chen Zhao, who's the head of economics research at Redfin, was very clear about this. He said that any monthly savings provided by this mechanism will be quickly erased because this would spur demand and push home prices higher. So we end up right back where we started, but now the consumers who successfully navigated that DTI gate are locked into decades-long interest-heavy financial products at inflated prices. This is structural price manipulation disguised as affordability relief.
I would frame the demand response differently. While any increase in purchasing power can influence prices, sure, the market needs tools to increase activity and unlock liquidity. The lower payments are especially critical for creditworthy consumers who, despite having stable income, rely on non-traditional income sources or are self-employed. These buyers often fall outside the rigid constraints of standard GSE government-sponsored enterprise underwriting guidelines. GSE guidelines are designed for predictability, not for flexibility. A lower monthly obligation provides the wiggle room these complex financial profiles require to get approved, injecting vitality into a stagnant housing market.
And what's the practical alternative for a family priced out today? Just keep paying soaring rents that capture zero equity, zero tax benefits, and provide zero fixed cost certainty? At least the 50-year mortgage offers a cap and a foundation for wealth building.
That argument minimizes the systemic pressure this puts on pricing and on equity capture. This policy targets and encourages financial behavior where consumers focus almost exclusively on the monthly payment, blinding them to the overall lifetime cost of the debt. If the goal is to increase market activity, we have to ensure that activity is financially sound for the homeowner. By making principal repayment almost negligible in the first decade, the period during which the homeowner is most likely to move or need access to equity, we are exposing them to massive risk. The policy ensures that housing prices will climb higher, and the financial institutions will maximize their interest returns by holding borrowers in debt for longer. That's a net loss for consumer financial health.
Okay, let's pivot directly to wealth building. You focus heavily on the slow rate of principal repayment, but the primary way wealth is built in U.S. homeownership is through appreciation and leverage, not rapid amortization. The average holding period is far, far less than 50 years. Therefore, the immediate entry provided by the long term allows buyers to capture early equity growth through appreciation before prices climb even further, maximizing the effect of leverage. I would much rather see a buyer capture $100,000 in market appreciation in 5 years, even if their principal payoff is slow, than miss out on that appreciation entirely while they're waiting for some better loan product to come along.
But the comparison of equity build is devastating, precisely because it affects leverage and risk management. This proposal dramatically slows down the accumulation of wealth through amortization, meaning homeowners stay highly leveraged for far longer. This is exactly where the risk of being underwater lies. Let's look closely at those 10-year milestones. Using your figures, after a decade, a borrower with a 30-year mortgage will have paid off roughly 20% of their principal balance.
The 50-year borrower, paying nearly the same monthly amount, will have paid off only about 9%. That 11 percentage point difference translates to roughly $40,000 less equity in the hands of the 50-year borrower after only 10 years on a typical loan. If the market flattens or dips, which is always a possibility even locally, the 50-year borrower is at a significantly higher risk of owing more than the home is worth. They have virtually no buffer. This slow equity accrual makes it immensely difficult to sell, cover commissions, and move, effectively locking them into that first property, unless market appreciation continues at an unrealistically steep curve. They are trapped in place by their own low equity debt structure.
I'm not entirely convinced by that line of reasoning because it ignores the powerful utility of optionality. The 50-year structure offers built-in flexibility that a rigid 30-year loan just doesn't. It provides the borrower with the lowest necessary required payment, that safety net we talked about for times of financial stress. Crucially, nothing prevents the borrower from accelerating payments. The 50-year term is merely the maximum possible duration. A financially disciplined borrower can make, say, 2 additional principal payments a year, or even just a few $100s extra each month. By accelerating payments, that 50-year loan can functionally become a 25 or 30-year mortgage, but the borrower always retains that low required minimum floor for security. It's a powerful tool that allows for a personalized repayment schedule, accelerate when income allows, and fall back to the low required minimum when hardship hits.
Well, that model presumes a level of financial discipline that is often lacking among the very demographic targeted by these payment-focused products. The Center for Responsible Lending often warns against products that rely on ideal consumer behavior to mitigate systemic risk. The majority of borrowers who qualify due to a marginal DTI improvement are, I think it's fair to say, unlikely to consistently make those accelerated principal payments. They are simply prioritizing cash flow, which is the institutional bet, and this brings us to the fundamental question: who truly benefits from this structure? The product is structured to overwhelmingly benefit the originators and the investors, not the average buyer. Lenders profit the most from the early years of any loan, when payments are almost entirely interest. By extending the term to 50 years, institutions ensure they hold buyers in high-interest debt longer, maximizing the total return on the life of the asset. And institutional investors who care intensely about predictable cash flow will be incentivized to snap up properties under this favorable term structure, further reducing the scarce supply available to individual buyers. This is a debt machine masquerading as a housing solution.
I acknowledge the institutional profit motive, which, exists in any major financial market, but I would frame it differently in terms of necessary market dynamics. Longer repayment terms naturally increase the accessibility of U.S. properties, especially higher value ones, to a wider range of capital, including global investors and institutional funds. This demand for debt instruments creates deep liquidity, which is a positive economic force. When the 30-year loan was established, its goal was precisely to increase liquidity and capital inflow into the housing market, making high-value assets more tradable and accessible. We can't argue for a dynamic, growing economy while simultaneously imposing artificial limits on the duration of debt products simply because we worry about the total theoretical interest. The focus should be on creating options and ensuring robust disclosures, not limiting consumer financial choices.
The problem isn't the options. It's the option that structurally harms the consumer while solving none of the underlying supply problems. If the goal is true affordability and market mobility, policymakers should address fundamental structural issues rather than offering these extreme term extensions. You mentioned that the current system is locked up. Homeowners are sitting on low 3% rates from the pandemic era and refuse to move, creating an acute supply lock-in. A genuine solution that addresses this supply constraint is the implementation of portable mortgages.
Portable mortgages are a great idea in the abstract, but they run directly counter to the institutional plumbing of the U.S. mortgage finance system, specifically the securitization model. Let me unpack this for just a moment. The U.S. secondary mortgage market relies on mortgage-backed securities, or MBS, where loans are bundled and sold to investors globally. The value of these bonds relies on highly predictable cash flows and the collateral, the specific property, remaining constant. So, letting borrowers carry their existing 3 or 4% rate to a new, different house
requires the investors in that MBS pool to absorb massive and unknown collateral risk associated with the new property, potentially forcing the loan to be repurchased by the servicer. It would fundamentally destabilize the entire securitization market and cause investors to flee, tightening capital flows dramatically. It is institutionally implausible in the current American environment. The system is built on fixed, property-specific collateral.
But that institutional barrier only confirms that the system is broken and designed primarily to maximize origination fees and interest rate resets for lenders. Lenders prefer forcing buyers to refinance or originate new, higher-rate loans because that's where the profit is. Portable mortgages, where the borrower moves and keeps their rate, would immediately improve mobility. They would unfreeze the existing home inventory by encouraging rate-locked owners to sell, directly injecting supply back into the market, a direct solution to the structural shortage. Extending the debt term to 50 years is merely the path of least resistance for institutions, allowing them to extract more interest while avoiding the difficult, necessary reform of the securitization system. Analysts are clear. Extending the term is a dead trap, not the best way to solve affordability.
Look, if we must choose between the institutionally plausible solution that offers immediate consumer access and the institutionally disruptive solution that addresses supply over the long term, I maintain that the 50-year mortgage offers the most immediate relief. It is not an end-all solution, but it is a vital tool. It provides a path into homeownership for those currently priced out. While the long-term interest accrual is substantial, the loan functions as a flexible instrument, a launch pad that can be managed, accelerated, and ultimately superseded by refinancing or early payoff when the borrower's financial position improves. It grants the crucial key of entry, which is the most difficult barrier to overcome today in these highly constrained markets.
We agree on the crisis, but we fundamentally disagree on the remedy. The 50-year proposal offers a minimal amount of short-term cash flow relief in exchange for nearly doubling the lifetime interest paid and reducing wealth accumulation to a crawl. It minimizes the primary wealth-building function of homeownership, principal payoff, and locks borrowers into decades of highly leveraged debt with minimal equity cushion. This payment relief will be quickly capitalized into higher asset prices due to the demand subsidy, enriching the financial institutions and investors who hold the debt, rather than solving the fundamental crisis of housing supply and price.
So the debate over the 50-year mortgage reveals this profound tension between the urgent need for housing access today, the desperate need to get people off the rental treadmill, and the critical importance of ensuring the long-term financial stability of the next generation of homeowners.
And the essential question remains for the listener. Is market entry at nearly double the total interest cost a worthwhile trade-off, or are we simply delaying a necessary reckoning with our broken housing finance system?